Oh, and also, I finally watched a movie last night, Margin Call. I'm going to be honest. I watched all the YouTube clips of this movie. That was awesome. And I watched the whole movie. The movie was not as good as the YouTube clips. I'm going to be honest. Wow. It's a pretty bad movie in between like the movie clipped parts. I will also say as well, I feel like that movie assumes quite a bit of like finance knowledge to understand like what the fuck is even going on. I don't know if it's just they expected everybody to watch that movie to know instantly, like, why is it a big deal if this company is over leveraged, or why do they have to sell everything? Or like, why is it bad if they sell things, or why is it bad if they sell things but they don't buy things? Like, they never actually explain any of that in the movie. So like the friend that's with me they're like, why does it matter if these guys sell everything? Or like, what does it mean when they say that like volatility is high and it'll be bad? Or like, how can if it goes down by 25%, how can that wipe out the whole company? And I'm like, well, there are answers to all these questions, but like, yeah, they don't explain any of this in the movie at all. I guess you're just supposed to have like a decent understanding of like finance before going in. Jesus. How would they have included background info while keeping the tone of the movie the same though? I don't know. Usually you do exposition through another character. Like, oh, if we don't sell these, then like they're going to, or like we have to buy things from people and sell. Otherwise people are going to know we're doing whatever. I don't know. There's the scene where the guy has to dumb things down for the CEO. Your friend just wasn't paying attention. Yeah, but you still didn't really have an understanding of what they were saying, even in the scene where they dumb it down. He's like, oh, well, if you were playing musical chairs, the music has already stopped or whatever. I feel like if you don't understand like concepts related to like, if you don't understand leveraging really well, it's hard to understand why anything could really be that bad. Like if you've got a whole bunch of assets on the books that are going bad and they're worth $1 million and you sell them all for 65%, I guess you've lost money. That's bad. But people don't understand that like if you're 20 to 1 leveraged on something and it goes bad, it can go really bad. Like easily over the value of your entire company, depending on how many of these assets you have in your books. But like, and I feel like that adds a bit to the drama. Like, because if you're an ordinary person, you've got like $1 million in stocks and they fall by 20%. Well, who the fuck cares? Like, I mean, it's bad, but like, okay, but like compare that to when you're very over leveraged on something. It's a whole different ballgame. And even the name of the movie is Margin Call, but that I don't even think that concept isn't even brought up in the movie, and nothing related to a margin call even happens in the movie. Did they just like pick like a random finance term, or like what the fuck? Yeah, I don't know. But margin call is kind of the theme behind why the company might go under, though. Is it? Not really, is it? If you're 20 to 1 leverage, that's margin. If the market falls enough, you're forced to liquidate your 20 to 1 leverage position. That's a margin call. Yeah, I understand, but that's never really brought up, and that's never really because it's a fictional firm, but this fictional firm never had a margin call happen. They sell everything first. There is no, I don't know. Just explain those concepts. Explain like M5 for us uninformed. I don't know. I don't know how to explain them because I don't understand any of them. I just like to pretend I know them. If you own a stock and that stock is worth $100, if the stock goes from $100 to $80 and you're forced to sell it, you've lost $20. Okay, so you have $100 invested in the market, but then you've got $20 that you've lost against your $100 invested. If you buy one stock for $100, the most amount of money you have invested is $100. The most amount of money you can lose is $100. Now, in an ordinary stock market, I'm assuming you're trading real companies, the chance of you losing more than like 20% is incredibly low, unless you're buying meme stocks, right? Like that's your exposure. Your exposure is like, I don't know if you say 1 to 1. Your exposure is whatever you put in. You put in $100, you could theoretically lose up to $100. That's the worst case scenario. The problem is when you start. So leverage is when you take some money and you use that money to try to get way more money. You've got a little bit of money that's like controlling a whole bunch of money. And the nice thing about leverage is when you're using a little bit of money to control a whole bunch of money, when that whole bunch of money goes up, you can make a lot of money. But when a whole bunch of money goes down, you can theoretically lose a lot more than you've put in. If you want to take an example actually of a really basic form of leveraging that most people are going to be aware of, we could look at mortgages. Mortgages are a really good ordinary example of leverage. So let's say that I buy $1 million house with $100,000, right? Well, I'm leveraged on my money because I've taken $100,000 and I've used that to now control $1 million in assets. Now, if I had $100,000 and that appreciated by 10% in the stock market, I've made $10,000. But if I lose 100% of that $100,000, I've lost $100,000, right? My exposure is still 1-to-1. There's no leveraging, there's no whatever. I can gain whatever the money appreciates to, and I can lose whatever I put in. But if I were to buy a house for $1 million and I have $100,000, if that house appreciates by value in 10%, I've just doubled my money effectively because I've got $100,000 that I put in and it's worth $1 million. Instead of appreciating 10% on my initial capital, what I would have gained $10,000, I can appreciate on the whole amount that I've leveraged myself on, right? I can get $100,000. So that 10% appreciation in that asset has now made me 100% on my initial investment. But let's say that house loses 50% of its value. Well, now I'm in a really scary spot because I used $100,000 to secure $1 million in debt against an asset that's now worth $500,000. If that house were to explode tomorrow, I didn't just put in $100,000 and lose $100,000. I put in $100,000 and now I'm in the hole $900,000. My exposure, meaning like how much risk are you potentially looking at, or what kind of loss you're looking at, is way bigger. You would say 10-to-1 there, right? Your leverage 10-to-1, right? If you did a $100,000 loan against a $1 million mortgage, against $1 million asset, I think you would say, right, 10-to-1 leverage, right? Now you're fucked because you can lose so much more than you initially put in. It's not like if the house goes under, and this is part of the reason why the housing crisis, there's a whole bunch of, it's not even an important part, there's a whole bunch of other stuff too. But like, yeah, that's the problem with leverage. With leverage, you can make a lot of money because any appreciation on an asset is basically is multiplied because of your because of how leveraged your initial capital is. But if it starts to lose money, now you're super fucked. To go one more step further, a scary thing also about leverage is, let's see if we can get to this. In order for you to have an investment, your downsides are probably going to be capped based on the relationship you have with your broker, your market maker, or whoever you're trading with. Meaning that when you start to hit too much of a negative balance, they're going to say, hey, listen, you're looking like you got a pretty exposed position here. I need you to give me more money because I don't trust that you're going to be able to cover your position if this thing goes. So you might have $100,000 invested in a house. The house is worth $1 million. I shouldn't be using a house for this because margin calling doesn't happen with a house. But let's say I've got like $100,000 and a company is letting me trade with $900,000 in margin, meaning that's money they basically loan me to trade. Well, let's say that money starts to go down, right? So I'm using $100,000. They've lent me $900,000, but my investment that was $1 million, let's say it falls to $700,000. Technically, I owe the people that I'm trading with $200,000. If my account gets negative enough, maybe $250,000, they might say, hey, the margin that we're giving you is too much. We're loaning you too much against the value of your asset. You need to give me cash now. Or, and this is a really scary thing, in a margin call, two things can happen. Either one, they say, hey, I believe that one of two things happen. A margin call can be them saying, you need to give us more money because your account is not liquid enough. You're not meeting your capital requirements. This happened a lot during the GameStop shit. Or they might say, listen, sorry, you're too low negative. You haven't fulfilled your capital requirements. We're closing your position. And when they close your position, what that means is now they forced you to sell whatever asset you have. And now you're not leveraged at all. Now you just have a bank account that says negative $200,000 or whatever, however far down it goes. And now you have to just pay them money and you're not even investing anywhere. You're just fucked, right? So in a margin call, I believe a margin call can either be asking you to fulfill a capital requirement, meaning you need to capitalize the account by putting in more money, or they'll close your position and say, sorry, we're just selling it and now you owe us this money. And then you're fucked. If you ever hear about people getting ultra uber fucked on like Wallstreetbets or like traders that do options or whatever, they don't get ultra fucked by losing all their money, although that sucks. They get ultra fucked by being leveraged, having a margin call on their account, not having the proper capital requirement, and then having the company forcibly close their positions while they're in a severe deficit, meaning now they just have to pay. And if the stock or security or whatever they were betting on goes up in the future, it doesn't matter. They've lost out on all the potential gains because their position was forcibly closed. Ugh, okay, Jesus. Anytime you engage in any kind of positions where there are margins, things like the capital requirements and when they'll forcibly close positions, all of that is going to be spelled out in advance for you. It's not like they randomly do this and be like, oh, I don't know what happened, but yeah. This happens with banks as well with capital requirements. Yes, it happens with everybody. Banks will have capital requirements. Market makers will have capital requirements. Like huge middlemen will have capital requirements. Brokerages will have capital requirements. All sorts of people, like Robinhood, for instance. One of the reasons why a lot of people's positions on GameStop started to be forcibly closed is because the volatility on these assets were so fucking high. More volatility means that people who are in charge of actually making these market trades, because Robinhood doesn't engage with the market directly, they go through market makers, started to increase the capital requirements so much if you wanted to buy or sell any of these securities that Robinhood couldn't meet the capital requirements because the volatility was too high. So eventually Robinhood had to start closing people's positions. It's like, we can't do this. We don't have the capital to like ensure that these trades will actually go through because it could go up or down way too much. But that's a whole other complicated, but okay, that's Jesus. The reality is they just closed those positions because they were rigging the market because they hate you. Why do banks or brokers even loan these amateur traders money when most are essentially gambling? It seems like a very bad decision for the lenders. No, what do you mean? It's a great decision for the lenders. Most of the time you're going to lose out on money because you're a retard and they have a bunch of services that you pay extra money for, and then they'll close your positions if there's too much exposure, if it's too much risk. Like, it's just free money for them. Frictionless trading and the idea of like the amateur stock broker, or not the amateur stock buyer that has no fucking that has like no idea what they're doing, and then making that trade frictionless. It's just an easy way to grab people. It's just an easy way to grab people and make money, I guess. Yeah. Someone who's written stuff for institutional brokers who trade this shit. The contracts are wild. Everyone is leveraging their assets that are owned via other contracts with everyone. Yeah, I mean, like I think you get into weird places where you're making like underlying assets are having so much other money that are kind of like betting against them. Like, there's a lot of leveraging going on. They kind of do this scene in The Big Short. Them not allowing you to buy GameStop but still allowing you to sell was fucked up. No, because selling is easier because you don't have to worry about the liquidity there. This gets way more complicated, and there's no reason to get this deep in, but I'm not going to do this too much. But like, this is the issue, okay? And I don't even remember this stuff perfectly, okay? I'm going to do this in like 2 seconds, okay? If you don't believe me, then suck my dick. When you buy something from Robinhood, when you buy one stock in Robinhood and then the stock is in your account, that stock doesn't exist. You don't actually have that stock, okay? That's not real that you have it instantly. That trades can't happen that fast. What happens is when you buy that stock from Robinhood basically, they group all their orders and shit together at the end of the day, and then they fill these out with whatever their market maker was. I don't know who they're using, but these huge market maker companies, you've never heard of them, you don't know it. These are people that actually go onto the market and they buy and sell in huge groups. So they're always buying or trading like in thousands of shares at a time or whatever, so that they always have the liquidity on hand to ensure that these trades are being done with the people that work with them, right? So the problem is that when you're buying things from Robinhood and Robinhood is saying that trade is cleared, it actually takes, I think is it T2? There's a term for this, but I think it takes it's 2 business days ordinarily for a trade to clear, right? But the issue is, okay, so, well, who cares, Destiny? Why does that fucking matter? Why can I sell but not buy? Well, because here's what's happening, okay? Ordinarily, on a stock in a major company, the price isn't going to change that much, right? So Robinhood might say, hey, listen, today we had 1,000 people that wanted to buy stock A. And they register that. All these people get their stock A. They're like, yeah, cool, I got to trade. That's so awesome. I'm happy. They got stock A, blah, blah, blah. But they don't actually have it. Remember, they don't have it. Robinhood is putting in this trade with their market maker, and the market maker will say, okay, well, we're going to go to the market. We're going to buy and sell these. We deal with so much volume. And we make money off the spread, and we close the spread a little bit. We make a few cents, blah, blah, blah. It's all good. Don't worry. That's fine. But let's say that stock A starts to run into an unprecedented issue where, also, hold on. So as a part of that, just to be clear, when Robinhood is buying these huge amounts of shares from these market makers and then transferring to the company, they don't have all the money on hand for every single buy and sell. They can't possibly, right? Because if you're depositing a little bit and you're buying, like, Robinhood they're engaged in so much business where they're buying and selling. They don't always have the underlying amount of money, because also you don't always know how much money you're going to need, right? Because they might say, I'm going to buy stock A, 1,000 shares, but by the time the market maker actually delivers you stock A, it might have gone up a few cents in the market, right? Or it might have gone down a few cents. There might be reasons why the price changes, all right? But let's say that stock A, for whatever reason, is unbelievably volatile, which is what was happening with GameStop, such that stock A's price might change by 100% in a day. There might be some wild shit going on. Well, now your market maker is like, okay, well, hold on. When I'm buying and selling this, I don't know what the fuck the price is going to be in 1 hour, let alone 1 day. So if you want to put in a deal with me where you're buying 1,000 shares of this, that's fine, we can do it, but I'm increasing your capital requirements. You're not going to put up 10% of the cash for these trades and wait until everything clears. I need like 50% of the cash because I don't think you can afford this, right? You're telling me that you want 10,000 shares of GameStop. Today, that's worth $10. What if tomorrow, by the time these trades clear, what if GameStop is worth $30 each? I'm in the hole for that because I bought that for you. The trade hadn't cleared. you're going to have to satisfy a huge capital requirement, and this stock is increasing like crazy. You're not going to be able to satisfy it. So if you want to do the trade, that's fine. But now I'm increasing your capital requirements by 30, 40, 50, 60%, which is for this particular stock was way too much. So now Robinhood says, okay, well, I can't meet those capital requirements, which is what happened, and that is what they said. They can't do it. So now they have to tell their customers, listen, sorry, you can't buy this stock because we don't have the capital to actually ensure that these trades settle correctly, and everything will get fucked. If you want to sell your shares, you can, because you don't need capital to sell the shares. But for buying them, we can't meet the capital requirements right now that are being imposed on us by, I think somebody said Apex Lending was the middleman or their market maker here. But that's essentially what happened. But everybody thinks that Robinhood just rigged the market because they hate the small guy or some stupid retarded shit. So whatever. Yeah. In the case of Robinhood, they had to renegotiate with their market maker, which took a little while. Yeah, but it was too late. The conspiracies were already done. In like 2 days, people had already... No, I'm sorry. In 1 day, in like 12 hours, people were already like, no, it's fucking rigged. This is bullshit. They don't want the little man to win. Destiny, don't know. Why do Republicans want to limit a person's right to vote? Example, limiting voting to just 1 day. If voting was limited to just 1 day, some voters may not be able to make it to the polls because they may be stuck or work. I don't know, bro. It's I don't know. Nobody has values when it comes to voting. That's what I think. Yeah. These market makers actually control the markets? Isn't it weird that no one actually knows? Oh, nice Pepe face. The reality is that the problem, in my opinion, is people just really want to remove all the friction from trading, but there probably should be friction with trading. Fuck you. Like, it should take a little bit to buy a stock, have it settle, like have the trade clear, get the stock in your account. But people always want that shit instantly. So, yeah. What was the name of... there was a name for what Robinhood engaged in. I say engaged in like it was illegal because people called it front running, but it's not actually front running. There's a 4-letter acronym, I think. Fuck, what was it called? Somebody tell me. There's a way that Robinhood made this so there was no cost. Preferred order flow. Oh, it was something to do with order flow. It wasn't preferred overflow. It was something. Oh, payment for order flow. That was it. So that market maker would actually pay Robinhood for their orders to fill those orders. I feel like we're getting into such... No one cares for any of this. People call this front running, but it's not. It was stupid. But basically what happens is let's say that there's a stock, and let's say that the spread on that stock is... Let's say it sells for... let's say that right now it sells for $1, but you can buy it for... or it sells for $100, but you can buy it for $96, right? The market maker might actually sell it for $99 and buy it for $97, basically. So they're, or no, wait. Hold on, fuck. I always fuck this up. If your spread is 196, the market maker will buy for this, but then I think the market maker, they buy for 100. No, they must sell for more. I don't remember how. Fuck. I need to look this up again. The market maker will basically, they profit off the spread of this by giving you more liquidity. But in order for payment for order flow to be legal, though, I think they have to offer price improvement to the customers. So I'm trying to remember how, but somehow they will close the spread on a given security because your order will be improved as a consumer way over here, but they make money by closing the spread too. I don't remember how, though. That seems counterintuitive because if the spread is 196 and you buy for 100, you would have to sell it for more, right? I don't remember. There's a way that this works out, but the Big Short demonizes a lot of these derivative markets, and they sound like very bad. Like you could be greedy and use them for making a ton of money. But the reality is derivative markets can be used responsibly too. Like you might short something, or you might have like options on something as insurance to make sure that if the price moves too dramatically in one direction, your underlying asset is a little bit more secure than it would otherwise be, right? But who cares? Okay. The issue was that Citadel that was a market maker for Robinhood had short positions against the stock. Then they decided to increase the requirements of GameStop. That's why it might seem shady for retards. I don't even know if that's true, but I don't remember if... I would have to go back and dig, but I think that the issue with what you're saying there is I think when you say Citadel, there were multiple companies. There were 2 different companies called Citadel. I think one was a market maker and the other was like an investment firm, but these 2 things operated independently of each other. I'm kind of remembering that, but I would have to go back and check before I make like really confident statements on that. No, they didn't. He's talking about Melvin Capital, who Citadel bailed out when they got liquidated for a few billion. Oh, maybe it was that. I don't know. Have you been on the Super Stonk subreddit lately? It's so sad. Do they still exist? Remember when they were convinced that the mother of all Moabs or whatever, or the Moaz mother of all short squeezes was coming, and then they tried to pick out new meme stocks because they wanted to recreate the magic of GameStop over and over again. People learned about the term short interest for the first time in their life and started picking and choosing stocks exclusively on that. Jesus. Do you think progressives should look to emulate more patriotic or American style progressivism from the early 1900s with people such as Teddy Roosevelt instead of trying to tear down everything? Maybe, but I mean, conservatives are tearing down everything too. So, you know, Somebody said, aren't short sellers bad because they're devaluing somebody else's actual investment, especially when they're a company like Hindenburg, who also release shorting articles to try to drive prices down? That's fine. Shorting is part of a healthy market. There should be people looking for companies that are overvalued. You want that. That's an important part of corrective market forces. Companies will try to drive their prices up, right? What do you think Apple is doing when they do their next convention or their next, like, what are they called? When BlizzCon happens, or it doesn't happen, I guess, this year. Or when, like, Microsoft has their conventions or whatever. Like, people are trying to drive their stock prices up by showing off their products. You also want people on the other side trying to call them out or, like, look for bad things happening, you know?